Good morning, everyone, and welcome to the Ankerstar Wealth Market Update. I'm your host, Allison Ankerstar, and today we'll be talking about the recently announced Amazon stock split, how stock splits actually work, and we'll finish with cybersecurity firm Crowdstrike's earnings release. But before we begin, as a reminder, this is a financial education presentation and should not be construed as personal financial advice. Full disclaimer information is available at ankerstarwealth.com. Good morning, Steve. Yesterday after the bell, Amazon announced a 2-for-1 stock split as well as a $10 billion stock buyback. How does the stock split actually work?
Hey, good morning, everyone, and thank you for that intro, Allison. I cannot even express how excited I was yesterday when Amazon announced the stock split. A couple of reasons. First of all, I called it, and there's no better validation as an investor as when you start talking about something months ago and then it actually happened. So last year, if you remember in 2020, late in either 2020 or 21, I can't remember. Both Tesla and Apple, it was 21. Both Tesla and Apple went through a stock split. Now they were smaller than this. They were like 4-for-1, 5-for-1, that sort of thing. However, at the time I started talking about both Google and Amazon and how they would benefit from a stock split because both of their share prices are, between $2,500 and $3,000. So we're going to get into, how they work here in a second. But certainly saying that they should do something and then the board of directors comes out and does it as well as announces a buyback, which we'll talk about a little bit later. So here's Amazon stock in the reaction. Now this is a one-day chart. You can see how this is where they announced it yesterday at around, look at that, 1638 exactly there Eastern time. They announced and boom, the stock popped and then kind of settled in from there, but certainly still up. Had an up day yesterday and everything was up yesterday, right? And then had it tacked on another 4% after the bell. So really, when you look at where the stock is, stock's really on sale right now. It's below 3,000. It had been up almost to 3,800 there for a while. And then when you look at the PE ratio, you're still at a 43, which is a little bit expensive, of course, but this is Amazon. These are the people who brought stuff to your door in the middle of the pandemic. If we've dealt with some variants, right? And there's the memes out there where the next variant's like, ooh, yes, just getting ready to go, sort of thing. So we don't know what's coming with COVID or the next thing, but we do know that Amazon was able to run and deliver and make it, to where we could live in our homes and get stuff delivered right to the door, really without much interruption. So fantastic company. Really, I think it's a strong buy here. But the question is, how do stock splits work? Well, I'll bring up this now. I'm not familiar with the site, so I'm not vouching for them. Do your own due diligence. If you use this site, we have no relationship, that sort of thing. But I did find this site that talks about the history of stock splits, which was kind of cool because you go down here and you can click on like Amazon stock split history. And then you can see that, okay, there's been 3 in history prior to this, according to their database. They're not trying to say we know everything, but we researched it, and that's the case, right? A 2-for-1, a 3-for-1, and another 2-for-1. These were all before the tech crash of 2000, right? So really a long time ago, and the stock has just really run since then. So let's talk about how they work, since that was the actual question. So with the stock price of Amazon at call it 3,000 just for the math. So you take the current stock price, and what happens in a stock split is in this case, it's 20-for-1. So you 20x the number of shares, but you make their value divided by 20. So, okay, blah, 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 right? So in this case, if for a $3,000 share-ish, divide that by 20, that would mean the new share price is $150 a share. If you had 100 shares, now you have 2,000 shares. So really, when you take the number of shares times the share price, it equals the same amount. So when you talk market cap for companies, Amazon has one. It is what it is. The market cap stays the same, even though the share distribution changes. So what does that really do, and why is it a good thing for the stock? It reduces the share price. So the analogy I use to some folks is you have $100 in one hand, and then you have you could do a 20-for-1 split on that 100, and then you have a whole handful of $5 bills, right? So you have $25 bills in one hand, you have a $100 bill in the other hand, and they're the same, right? I'm the same amount, but that can feel different, and you can spend $5 at a time. Well, more so than just having 100. So when you think of that in reverse, most people are buyers of stocks, the net buyers out there. When you look at picking up some shares of Amazon, some people might not have $3,000 in their account. So they're like, well, I'll pass and go on to something else. Where if a share was 150, or in this case, 140, you do the math, 146, 48, whatever. They could, if they had a $500 in their account, buy a share or two of Amazon. So that gives a little more access to it. There's also, and it's a little bit nuanced, but there's also, this brings a lot more flexibility to the options world, because the price point is now is smaller, so you can go at different levels in options. Most people aren't into that, so that's all I will say, is it does bring some more action into the options market. So why is it a good thing? More shares out there for people to pick up. Nothing changes for you. If you owned it before, you now own the same amount. If you didn't own it before, you still don't own any, right? So consider buying it from here. So in conclusion, stock splits tend to be a good thing, because the stock price goes down in denomination and people tend to buy more right there. So it has tended to be a good thing over time.
Next, how does stock buyback work, and why is it a good thing for shareholders?
Well, in addition, like Allison said earlier, Amazon announced they're doing both the split and the buyback. So we already talked about the split. So you have more shares at a lower price point. Now, a stock buyback, when a board authorizes a stock buyback, it's the opportunity or the ability or the authorization to buy back stock. So that doesn't mean they're stroking a check tomorrow for 10 billion to take that down, because if they did that, first of all, I think they have to announce all purchases, and I can't remember the time frame, a week or 2 weeks, or there's some rules that govern this and I'm not familiar with, but know that there are rules, and that they don't have to buy, they don't have to spend all that money on buyback. That's if you will, a budgeting slash management decision, is that they have some cash that's available to roll in and do buybacks. If if you announce a stock split and a buyback and your stock doubles, well, you may not spend any of that money on a stock buyback, because you'd rather buy your own stock back, i.e. retire it at a cheaper price than a higher price. So this is Investopedia, which is a pretty good place to go. It's open source, so just like Wikipedia, it's not a sourcing mechanism, but it is written at a fairly readable level. I think probably a middle school type levels that you can understand. So it's a good place to go. And there's always the key takeaways. So key takeaways occurs when a company buys back its shares from the marketplace. So you can look up how many shares are outstanding, and as soon as they do the stock split, there will be 20 times that, right? So if there were 1 million shares out after the stock split, there will be 20 million shares out. And then they can go back and buy these back to the company and retire the share. So that means the shares come off the book. So if there's 20 million shares and they buy 1 million of them back, then there are only 19 million shares outstanding. Now, Amazon does not pay a dividend, so therefore they're not saving, some of the bigger dividend companies like to buy their shares back because now they don't have to pay that dividend. Not bad. But by retiring these shares, you think of, say you own 1 share of Amazon. Now, you are an owner of the company. That's why we like individual stocks. You are, in fact, an owner of Amazon. Now, a very, 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 very small part owner. I get that. But when the team at Amazon decides to retire even 1 share off the books, your share fractionally is worth more. Yes, we're talking several places out on the, several decimal places over, but yeah, fractionally it's worth more. So if you look at a company like Apple that has retired a lot of stock, that does help boost the stock price, just because there is less available. So therefore the earnings per share, take the earnings per share. So think fractions, shares on the bottom, you reduce that number. So the fraction goes up, right? Because you reduce the denominator there. So the effect of buyback is to reduce the number of outstanding shares, increases the ownership stake. That's what we just talked about. And, why would a company do it? Well, if they think their stock is cheap, you wouldn't buy back your stock if you thought it was expensive. Right. So overall, it's going to be a boost to the stock. So in sum, whenever you hear a board authorizing a buyback, that means that they value their company as undervalued and are a buyer at that time.
Last, Crowdstrike crushed earnings yesterday and received a huge upgrade this morning. Is CRWD a buy, sell, or hold?
Well, CRWD is an individual name in the cloud computing / cybersecurity space that is obviously gotten a lot of attention after crushing earnings yesterday. It moved up 8% yesterday and another 11 plus after hours. You can see the big bump there in the stock. When you zoom out a little bit, yeah, it's been beat up like everything else in the tech world, right? Was up at 280, just went down to about 160 or so, and now sitting at 190 this morning. I think it's a clear buy. In the individual space, you've heard me talk about this several times. There's times with each investable theme, of which cybersecurity is one, you can pick an individual name if you can find best of breed and own that. Or if you can't or don't feel like you have the expertise, which in my case, I do not, I'd rather own the whole space through an index fund, which CIBR is what I use. Do your own diligence for either of these, of course. But when you really look at CrowdStrike, you're like, okay, this looks amazing. Good entry point, all that. It's like, okay, yeah, I'm going to buy some here. Then you get down into, negative P ratio. What does that mean? It means, there aren't profits, right? It's negative. They're losing money, to the tune of minus $1.03 per share. I don't know if that's the updated number from yesterday or not. It is not. That's a September number. But there'll be new numbers out, so you got to watch. If they're not profitable, may keep you out of that name, and it may be super expensive. So when you look at margins, you're looking at high margin, right? It's going to be software type cloud-based stuff, but then again, their return on equity, they could be growing out, a lot of capital expenditures on stuff. So gosh, could be hemorrhaging cash too. So that's why I prefer to go with an index fund versus this. But to answer the question, I'd say overall, CrowdStrike, if you want to hop into this name, it would be a buy.
Thank you, everyone, for your questions. Please submit your questions as a comment through social media or directly to our email at vipservices@ankerstarwealth.com. And don't forget to like and subscribe to get daily updates. That's all we have for today's show. I'm Allison Ankerstar, and we'll see you back here tomorrow.